What's up, traders? How you doing, friends? Money Maxwell here, Good Kids Trading. I wanted to talk to you today about some alternatives to selling puts. Now, selling puts is my absolute favorite strategy. As a full-time trader, I depend on selling premium to pay the bills. But there comes a time where I don't always want to sell puts because I feel like the stock market is too high. I wrote about this in a blog, and I want to just cover it today because I think it's important that we kind of talk about some of the different things to think about instead of selling puts. You know, as Dr. Jim with Tasty Trade says, for every give me, there's a gotcha, right? So when you sell that put, you collect a lot of premium, but if the stock looks like it's going to pull back, you don't want to sell a put. You're leaving money on the table. So what if there were some other strategies out there that would allow us to still collect theta, get the theta decay, still makes a little less money, but actually make money if a stock pulls back? How good does that sound, to make money if a stock is actually going to pull back? The short put, very, very simple strategy. You go to the options chain, choose your strike. You can kind of see exactly where you're looking. And you come in and you look at the curve, and you can just tell, like, if Robinhood, which is the underlying here, if it goes up, we're going to make all of the money here. We're going to collect all $30, right? And if Robinhood for some reason goes to zero, yes, we are risking almost $1,200 to trade this. Do I think Robinhood's going to do that? No, absolutely not. Let's take a quick look at the chart. When I look at Robinhood right now, I see it's pretty extended on the weekly and the daily chart. Right? There's a pretty good ways down to the 100 and the 200 moving average. So do I think Robinhood is going to moon? It's very possible. But there is also a chance that Robinhood is going to pull back, especially with earnings coming up. So instead of just going out and selling a put right here at, a support, I love support and resistance. So like if you come down here and you look for some support zones of where you want to sell a put, what if you could actually make money if Robinhood comes in this area and you still have that naked put below? So you're making a little less in the front, but you benefit from a pullback. How does that sound to you? Because for me, that sounds like a great strategy when you go out and you look at SPY. Way extended off of the charts. QQQ is finally having technology is finally pulling back a little bit, but we're still pretty far extended. So as an options trader, I don't just look at the underlyings. I'm going to look at the indexes too. I want to see how far extended are we. If you're not looking at the bigger picture when you go to sell puts, you're going to have a really tough time at some point when the market inevitably pulls back. So with Robinhood, chart's a little extended. I have sold a lot of puts on Robinhood this year. As you can see, it's middle of July right now when we're recording this. And since 2024, I have sold 15 puts on Robinhood. They've done really well. The stock has a down move. You see how it's near the moving averages? I'm going to sell a put. I love down days like this where I can sell puts. I can get good premium. We're pretty close to the moving averages, right? We're not that extended. Well, now we're kind of getting in an area where we're starting to get a little bit more extended. Like the moving averages are pretty good ways away. Looks like we're almost 17% away from the moving averages on the daily chart. We're kind of extended. What are some alternatives that we can look at to trade other than the naked put? Let's talk about it. So let's take a look at the options chain. Like I said, yes, you can go out, you can sell an 18 put, you could actually sell the 17 put and still get 1% for 30 days, right? You can collect about $22 for the 17 put. You're one standard deviation away. You're a couple strikes away from the expected range. Looks like a good trade. I wouldn't personally love this trade as much, even with the high probability of hitting profit, just because we're so extended. But there are some other trades I want to talk about, like a put ratio spread. A put ratio spread is where you go out and you buy a put. So you come here and you click on buy and you sell two puts, right? So you're buying a put and you're selling two puts. I love to do this right at the expected range. So I've bought the 20 and I've sold two of the 19s. What I've done is I've created a put debit spread of $1, right? So if Robinhood were to fall to 17, this spread would go in the money and it would collect about $1. You can see here the max profit is $1.25. So it's the spread itself of $1 and the premium that you collected of 25 cents. And you know, this is all times 100, right? So $125 profit. And if you go and you look at the curve, right, the risk curve, you can see you get this little profit tent, right? So between 20 and 18 on the charts, you actually make a little extra money on this trade. You still have the same amount of risk. You're still risking that extra naked put for this component, but you've added a little bit of downside bonus with this put ratio spread. So that's the first alternative to selling naked puts, but there's so many other options too. Let's look at the other two real quick. What about if we sell a 1-1-1? So we're gonna buy one put. We're going to sell. Let's just kind of play around with this and see what it looks like. I want to make sure that we're actually collecting a credit, right? You want to sell the low 20 delta. So I look at delta for sure, you know, between 20 and 30 delta kind of gives you a good range of where you can sell. Let's just say, for the sake of argument, that I really thought Robinhood was going to pull back. And I don't personally think that Robinhood is going to pull back. But if I set up a 1-1-1 that looked like this, so we've bought the 21, we've sold the 20, and we've sold 118. Let's jump over and look at the risk curve here. And you can see that between 20 and 18, we can make an extra $100. And you're like, what, the put ratio spread? We could make 125. So why are you suggesting this? If you were super bearish and you thought, hey, I really think Robinhood is going to pull back, I'm going to set up this trade for $1. This is a cheap stock, guys. So like I would not set up a trade just for $1 credit. But like, what if this was 50 cents? What if this was Google? Do you get my point? Like, this is a $20 stock. If you're doing this on a $100 stock, it would make more sense. I want to stick with Robinhood on this entire example just so you understand what's happening here. You get a credit of $1. If Robinhood comes and it pulls back into the 18 or 19, even if it comes into the very beginning of your profit tent, that's what I call this, right? It's a profit tent. You can see as Robinhood pulls back, you get profit. It maxes out at the amount of the put debit spread, right? So you can only max out by the width of your spread. As it keeps going down, what's so powerful about the 1-1-1 is that if it pulls back and you're willing to take a little more risk, maybe you're willing to own 200 shares of the stock, you would just go into the table and, you know, you've collected what? $3 now, but you can go in and you can create another put sale. And you're going to say, hey, that's adding risk. Yes, but like this 18 put right now, if Robinhood pulls back into the tent, remember the tent was around 20. So if Robinhood pulls back, you're going to collect 75 cents here, right? So you would sell this and you would collect 75 cents. So you have a put debit spread. In this earlier case, you know, you would have a 1-1-1, but what if you made it a 1-1-2? So what I'm suggesting is the third alternative is you can convert this 1-1-1 into a 1-1-2 put spread. So instead of just selling one of the 18s, we would actually sell another one later on. We would leg into this position and we would have two of these. And now this credit is not going to be representative of what you're actually going to receive, right? Because you're going to get an extra $50 or $60 if you sell that 18 put. Now you can also just set up a 1-1-2 to begin with. You don't have to leg into the 1-1-1 if you aren't sure. So like this 1-1-2, yes, it has additional risk, right? My max loss has increased because I have two naked puts here. So instead of the $1,700, it's $3,500, right? So we have increased our risk with this trade, but let's take a look at the risk curve and let's just look at what we are saying here. So you come here and you look in between 20 and 18, you can make $134, right? So just the same way that we saw with the put ratio spread, you're making the width of the put debit spread and you have two naked puts instead of one. So your cost basis, if you were to get put these shares, you'd be at like $17.50, even though you sold the 18 because you have the 34-cent credit. So this is a very powerful trade. And like I said, Robinhood is a $20 stock. So I want you to think in terms of how many shares of a $100 stock, versus Robinhood, it's like 5 to 1, right? So instead of collecting $34 here, you could collect up to a dollar, $1.25, just depending on the size of your account and the share price of the underlying. I think the 112 is a really great strategy. Look at that theta. It's paying you $3 in theta. You got a little delta here. You can definitely change your strikes around. Like I said, I like to have a little buffer between the put debit spread and the naked put. I just think it works better for me. But you can do this with just any stock out there. It's going to look a little bit better on a more expensive stock just because this is cheap. I don't want you to think, hey, $37 is not that much money, because it is if you consider that we're only doing this for 30 days. I wrote an article about this. It's on goodkidstrading.com. And it's basically everything that I just discussed here. We talk about the short puts. I show you exactly what the options chain's looking like, what the risk curves look like, because I want you to understand there are ways to trade outside of just a naked put. So many people they think, oh, the stock's going to pull back. I can only sell naked puts. And if you only have one strategy, everything is going to look like a good trade to you. So add a couple additional strategies. I just gave you 3 alternatives instead of selling naked puts. And if the stock is low and it's at support, sell naked puts all day long. But if you're okay with reducing your premium received in the front for a little extra surprise to the downside, you should definitely check out the put ratio spread, the 112s, and the 111. Great strategies. Check out the blog, goodkidstrading.com. We have lots of good free information on the website. Join our Discord. We are showing you how we trade, not so you can follow us, but so you can learn some of the strategies that I use every day to make the stock market passive and profitable. Have a great day. Catch you next time.